All right, let's jump right into this explainer. We are looking at a truly fascinating and honestly rapid shift in the global financial system right now. The source material actually compares the current system to an old Western saloon. For nearly a century, the US dollar has basically been the old sheriff running the room, dictating the rules, putting everything on its tab. But that game is changing completely. And this is especially true for everyday retail investors who think they're holding safe haven assets. So we're going to explore the story of the paper casino and why the gold you think you hold in your portfolio might not actually be real gold at all. It might just be an IOU. So consider this stark reality for a second. Holding US dollar-denominated assets is merely holding a revocable permission slip. Now, what sparked this realization? Well, back in March 2022, a massive shockwave hit that global financial saloon we just talked about. $300 billion in Russian reserves were frozen, and the London Bullion Market Association suddenly suspended the good delivery status of Russian refiners. Now, setting geopolitics completely aside, the underlying financial message to the rest of the world was crystal clear. Holding paper assets in a centralized system means you don't actually own them. You literally just have permission to use them. For a retail investor, this is a massive wake-up call about the invisible counterparty risks lurking in your portfolio.
And this shift toward physical assets, it wasn't just some sudden overnight event. It's actually been a 20-year strategic buildup by BRICS nations. Look back at 2002. China laid the foundation by establishing the Shanghai Gold Exchange, moving toward a market-oriented mint. Then, fast forward to 2013 during the paper gold crash. When Western paper gold prices absolutely tanked, Eastern retail buyers didn't panic. Actually, they treated it as a generational buying opportunity. They mobbed jewelry shops, driving record physical withdrawals. And finally, that 2022 asset freeze we just discussed, that served as the ultimate pivot. It transformed the Shanghai Gold Exchange from a domestic market into a global, alternative pricing venue operating completely outside traditional Western jurisdiction.
Now, when you look at who is actually digging up the real wealth, a staggering story emerges. China is the undisputed #1 gold producer on the planet, mining 392 metric tons. The United States, on the other hand, ranks 5th globally, mining only 160 metric tons, which is actually a decline from previous years. But here's the real kicker for everyday investors who are tracking supply and demand. China has an ironclad law prohibiting the export of standard gold bullion. They keep literally every ounce they mine. The US, meanwhile, it exports roughly 300 tons of gold and ore annually. That's nearly double what it actually mines. So the physical weight of the world is, quite literally, shifting east.
All of this points to a massive underlying economic shift. You see, the West likes to wear the fancy suit of nominal GDP. The sticker price, where the US still technically leads. But beneath that suit is China's real muscle. If you want to see who has the actual physical strength to forge real goods, the sources point to purchasing power parity, or PPP. By that metric of real-world manufacturing output, China's real muscle economy sits at a whopping $38.19 trillion, compared to the US at $29.18 trillion. And armed with this superior physical strength, Eastern nations are rapidly losing interest in holding Western paper IOUs.
So why the sudden acceleration away from the dollar system? Well, it mostly comes down to the old sheriff's debt trap. With the U.S. national debt approaching a staggering $38 trillion, the pressure is immense. And even more pressing, the annual interest costs on that debt have now surpassed the historic $1 trillion milestone. That's a mind-boggling number. Because of these massive figures, the BRICS bloc is actively developing parallel financial infrastructure. They're reportedly working on a gold-anchored clearing system called the unit, and this is specifically designed to allow for global trade that bypasses the traditional dollar network entirely.
Okay, which brings us directly to the profound risk for everyday retail investors: paper gold. What is it? Basically, these are electronic contracts traded on Western exchanges like the COMEX. But the key word you really need to focus on here is represent. These contracts merely represent gold rather than being physical metal resting securely in your hand. Welcome to what the sources appropriately call the paper casino. If you're a retail investor buying gold ETFs or futures in the West, it is absolutely vital to understand that this is the table where you're likely sitting.
And the facade of this casino is honestly staggering. Check this out. A massive 95% of contracts on Western exchanges are settled entirely in cash. Just 5% result in physical delivery. Really think about what that actually means for your investments. The vast majority of buyers and sellers are just trading price exposure on a computer screen. They never touch a single bar of real metal. It's basically a game of electronic hot potato, heavily reliant on the fragile assumption that nobody will actually ask for the underlying physical asset.
But what happens if they do ask for the gold? Well, that brings us to an alarming reality.
54%. Projected for July 2026, the registered inventory, which is the gold in COMEX vault strictly certified for immediate delivery, has plummeted to just 54% of total stocks, and it's been falling rapidly just since January. According to the data, this inventory has been sitting at the 3rd percentile of its 6-month record. So the physical buffer inside the Western casino? It's training fast.
The game of financial musical chairs is at a critical stage right now. In financial terms, this is what we call delivery risk, and it is the absolute core vulnerability of the paper casino. Because so much of the market consists of paper claims stacked incredibly high on top of a shrinking pile of real gold, if even a small percentage of those paper holders lost faith and demanded their physical metal all at once, well, the exchange would break. It would face massive, sharp price spikes, and retail investors holding paper IOUs could be left completely stranded.
Now, let's compare how everyday investors are navigating this on opposite sides of the world. In the West, mom-and-pop investors are largely holding paper IOUs on the COMEX, carrying all that massive delivery risk we just talked about. Meanwhile, in the East, Chinese retail investors are utilizing gold accumulation plans. They make small, regular purchases that are explicitly designed to eventually result in the physical delivery of actual 1-kilogram bars. The contrast literally couldn't be starker. The West is passively buying delivery risk, while the East is actively demanding hard, physical assets. This intense Eastern physical demand creates what we call a hard physical floor. Unlike the Western casino, every Shanghai Gold Exchange contract requires real physical delivery of 99.99% pure gold right into certified vaults. The retail behavior there is shifting drastically. In 2025, physical investment in China actually outperformed jewelry consumption. And just look at the sheer volume. While the Chinese central bank officially reports 2,280 tons in reserves, analysts call this a floor, not a ceiling. Why? Because annual withdrawals from the Shanghai Gold Exchange hit anywhere from 1,500 to over 2,000 tons. This massive, relentless physical demand forms a price floor that the Western paper casino simply cannot manipulate or break.
So, we arrive at the ultimate question for your own portfolio. When the music stops in the paper casino, will you be holding gold or an IOU? As the East corners the physical supply and steadily shuts down the paper gambling games, the global market is facing a scarcity that will change everything. I really hope this explainer has helped you see the profound difference between paper promises and physical reality. Take a hard look at how your own assets are structured, because when the financial musical chairs finally stop, you do not want to be the one left without a seat. Thanks so much for joining me to explore this incredibly important data.